Hi guys, and welcome to another week ahead video. Now in this upcoming week, our main focus will be on the British pound. And the reason for that is we have seen some interesting moves in the pound over the last couple of 2 weeks. We had some negative comments from both the UK and the EU side with regards to the ongoing trade deal negotiations that saw some downside in the pound. And we also had some upside this week from the surprise resignation in the cabinet, the reshuffling that did cause some upside potential in the short term for the pound as the prospects of more fiscal stimulus gave the markets reason to buy the pound on the hopes that the BOE might not need to cut rates later in 2020. Now, in this upcoming week, we have a whole slate of economic data, including retail sales, the jobs report, CPI, as well as the very important Flash PMI numbers for February. Now, you guys remember that in January, one of the reasons that the market cut back on the expectations for a rate cut in the January meeting was due to a much better than expected PMI print. So that data will be very, very important in this week. And along with a couple of other factors that we will consider, we think that the pound can create some great trading opportunities for us in this upcoming week. So jump in with me now to the video. Let's see how we can prepare for this upcoming data and hopefully trade it in the week ahead as well. Okay, then looking at the baseline for the pound. Now, even though we saw that the BOE decided to surprise the markets by leaving rates on hold in January, we do still maintain a fundamental bearish bias on the pound and on the UK economy. Now, the most recent forward-looking data for the UK has arguably been better than expected. The first example of that would be the big jump we saw in the January PMI numbers across the board for both manufacturing, the comp number, as well as services, which was given as a main reason for some BOE members like Vliga to leave rates unchanged. Now, we also saw quite a big jump in the previous jobs report for December, showing a massive gain of 208,000 versus expectations of 110. However, the back-looking hard data like CPI, like GDP, has been less encouraging, with downtrends seen in core inflation as well as headline inflation, with the year-over-year numbers printing at 1.4% and 1.3% respectively, well below that 2% target of the BOE. In terms of growth data, it's also been very lackluster, with the Q4 GDP printing at 0.0% and GDP for the year-over-year numbers printing at 1.1%. Now, we also saw some short-term upside for the pound this week with the surprise resignation of Finance Minister Javed, who also was immediately replaced by Rishi Sunak, who is seen as being more aligned to the PM's ambitious spending plans and a supporter of tax cuts, basically in favor of lowering capital gains taxes as well as increased spending on infrastructure. Now, this saw an initial move to the upside as the potential of higher fiscal stimulus could take the pressure off of the BOE in terms of easier monetary policy. However, the main focus for the pound is still on Brexit, as the UK and the EU tries to get a trade deal in place before the December 2020 deadline. As long as the main focus remains on that, the bias for the pound should remain to the downside, even though we might have some whipsaw moves in the short term. Now, if the UK and the EU doesn't strike a deal before the December 2020 deadline, the UK will have to leave the EU under either WTO rules or with a basic free trade agreement. Now, ING Investment Banks explains that the pound is set to struggle for the rest of the year as both a free trade agreement as well as WTO rules would be a very negative for investment growth as well as cause uncertainty to rise. So there's definitely more downside seen on the fundamental side for the pound, which is why we have kept our fundamental bias to the downside and bearish for the pound. Now, looking at the baseline for the risk events coming up in the week, we have a very busy economic calendar with both back-looking hard data as well as forward-looking sentiment-based data on the schedule. First up is the December jobs report coming up on Wednesday. Now, after the big surprise beat we saw in the November report, the market will be tuned in to see whether the same upwards trend was maintained in December. Now, in terms of the market's expectations for employment, they are expecting both employment as well as average earnings to tick down from the November numbers. It's also very interesting to consider the above chart that basically tracks the UK total employment on a year-over-year basis. Now, there's been a steady downtrend after the Brexit decision back in 2016. On a year-over-year basis, but that move to the downside shouldn't really be surprising since the current unemployment rate is sitting at multi-decade lows. So that still points to an overall very tight labour market in the UK, even though that year-over-year trend has been trending lower. Then on Wednesday, we also have the January readings for CPI. Now, the downtrend in headline and core CPI is a little bit of a concern for the BOE. We can see that CPI has been trending lower from 2017. So that is something that the BOE should be worried about at this stage. The headline month-over-month and core measures are expected to contract for January. However, both the year-over-year measures as well, the year-over-year headline and core measure is expected to edge up to 1.5%. Now, on Thursday, we move on to the retail sales data. Now, one of the big influences that caused the market to price in a potential rate cut by the BOE in January was the surprise miss we saw in retail sales for December, as consumers failed to increase their spending for a record 5th month in a row. Now, that massive fall in consumer spending during the important Christmas period doesn't bode well for the overall growth prospects of the UK, which is why the markets were starting to started pricing in a potential rate cut by the BOE in January. Now, markets are expecting a very sharp rebound in the numbers for the headline month-over-month and core month-over-month numbers, but are expecting the year-over-year metrics to edge down slightly. Now, all of the week's data will be important, but the Flash PMI numbers on Friday will probably be one of the most important metrics for the week. The market saw a very quick repricing of rate cut expectations in January when the January PMI numbers showed a very sharp jump to the upside. Now, the reason for the jump in business sentiment was attributed to the positive attitude and size of relief for some businesses when the UK Conservatives landed a landslide victory in December in the general election. Now, some BOE members like Vliga has expressly mentioned that the forward-looking sentiment-based indicators like the PMI is one of his primary concerns. Thus, any further jump or miss in the PMIs could increase or decrease expectations for monetary policy going forward. So definitely something to keep on our radars. The main focus for the pound, however, will remain on Brexit and trade deal related developments. Also, after this week's short-term move in the pound due to the expectations of possible more fiscal stimulus, we also need to pay attention to any comments about the upcoming budget as well. Then looking at possible sentiment shifts now, for this week, the main attention will be on the trade deal between the UK and the EU. Our first attention for potential dovish shifts will be on that, and any further negative or pessimistic comments coming out from the two sides with regards to the trade deal can have a negative impact on the pound and can surely be tradable. Secondly, after we've seen that surprise resignation and the market's now expecting the possibility of more fiscal stimulus, any comments about the budget showing that we might not see that expectation of further fiscal stimulus can see some short-term dovish trading opportunities in the pound as well, and will probably bring the BOE monetary policy back in focus. Furthermore, any significant miss in the upcoming data can see short-term pressure on the pound as it will feed into the current bearish fundamental bias. Any significant miss in the data could also impact interest rate expectations, which is something we'll need to keep track of throughout the week. Now, even though all the data released next week is important, make sure to pay particular attention to that PMI data on Friday, as a quick turnaround in the numbers would cause speculation whether some BOE members like Vliga would opt for a rate cut if the sentiment-based indicators started moving in the wrong direction again. Now, the highest conviction dovish trading opportunity from this week would come from a combination of the above-mentioned points. For example, negative trade deal comments, followed by negative budget expectations, as well as big surprise misses in the economic data. Then looking at some possible hawkish sentiment shifts, given the current fundamental bearish outlook on the pound stems from the fact that the UK might leave the EU without a trade deal, any comments that show a positive change in tone from either two sides can see pound upside in the week ahead. One of the current areas of contention is regarding fisheries and financial services, so any signs that the UK or EU are softening their lines on these 2 points will be a positive move and tradable in the short term. Also, as we saw upside in the pound following the cabinet reshuffle this week, the market is now already leaning towards the possibility of more fiscal spending. Thus, any comments that confirm additional spending can provide additional upside for the pound as well. Then moving on to the economic data, the BOE was particularly focused on the sentiment-based indicators like the PMIs and noted a marked jump in business optimism following the general election in December. However, the highest conviction opportunity from the data would be a beat across the board in all the data points scheduled for next week, not only the PMIs, but the PMIs will definitely be more in focus. Any beat that decreases rate cut expectations from any of the data points next week should be market moving in the short term and can create trading opportunities. For the best trading opportunities next week, we want as many of the above mentioned points aligned to give us the highest probability expectation for more sustainable moves to the upside, given that the current fundamental bias is still to the downside. So how I can look to trade the pound this week. Now, in the case of a dovish sentiment shift, we could look to pair the pound against something like the Kiwi dollar, which has remained well supported in this past week after the RBNZ made a neutral tilt towards monetary policy and downplayed the expected impact of the coronavirus on the New Zealand economy. Now, as the Kiwi dollar is a high beta currency, make sure to pay close attention to the current risk tone. A risk on tone should be supportive of the Kiwi dollar, while a risk off tone should put pressure on the Kiwi dollar. Now, in the case of a hawkish sentiment shift, we could look to pair the pound against something like the euro, which was pressured in the last week due to a stronger USD, as well as a reawakening of fears about EU growth prospects. As both the pound and the euro is exposed to Brexit-related risks, there are fewer external risks with choosing to pair the euro against the pound. Remember that these trade recommendations are based on the current fundamental bias for these currencies at the time of writing and making this video, and can thus change throughout the week. Make sure to reevaluate whether the short-term sentiment is still valid for these currencies before you take any trades. Now, these type of sentiment shifts are valid for trading phase 1 trades. And if you want to learn how phase 1 trades work, you can check out our news trading strategy playlist on our YouTube channel, where we post weekly examples of how these trades play out. Now, after a phase 1 move, we can also look for a potential phase 2 pullback of that initial move. And we post updates on these moves inside our tradable sentiment shift report inside the Forex Source terminal under the Market Insights tab. Now you can see each day which sentiment shifts are still in play and which ones are valid for trading any phase 2 pullbacks. You can also learn about how these setups work during our live analysis webinars each day inside the Forex Source terminal.